next guest is as UK-focused fund manager. She says that the FTSE 100 will continue to outperform its other European peers going into next year. Indeed, if we look at the year-to-date performance, it certainly has stood out. Its 8% decline is much smaller than the 16% fall and almost 19% that we've seen for the DAX and the CAC. Well, now we're joined by the head of the UK Equities Fund at Royal London Asset Management. That fund has around £350 million worth of assets under management. Welcome to the programme, Jane Coffey. Welcome. Let's look. We've had a very busy weekend to digest David Cameron's veto and indeed what we find out that the rest of the 26 have got together and talked about on Friday. First of all, how significant is that veto when you're looking at managing investments here in the UK?
Well, I think as far as managing investments here in the UK, that veto is important, but it's not as important as it is for Europe as a whole, because it makes it much harder for them to go ahead and do what it is that they want to do as far as the fiscal union, using all the institutions that are already in place within the EU. What I think, though, for the UK is that the price that we had to pay to sign up to what they're proposing would have been way too high, not just for the city and financial institutions, but for the economy as a whole. What they're actually proposing within Europe is to stop fiscal policy ever being able to have more than a 3% budget deficit, whatever the economic terms. And that, you know, really ties one hand behind your back when you're trying to manage the economy.
We're still seeing live pictures of David Cameron battling it out in the Commons. We're both with Liberal Democrats and Labour giving him quite a hard time today. Did he secure the future of Britain's financial services?
I think it was less about securing the future of it, but minimising the downside that could possibly be there. So I think it's a step that he had to take. And really, if Europe is absolutely determined to go ahead, then maybe they should be doing some compromise with David Cameron rather than him having to compromise completely with them.
Now, so if we look at investments in the year ahead, despite David Cameron, despite what he was able to do, you don't favour banks as an investment in the UK or beyond?
No, absolutely not. I mean, my view is that whatever happens within Europe at the moment, they are going to go into a pretty austere time. They have to make a lot of austerity cuts across the board. All the peripheral markets have a lot to do. Even Germany is not exactly in a position to stimulate their economy, and therefore it's more than likely that Europe goes into a recession. Banks are obviously very cyclically orientated. Impairment charges we were anticipating were going to come down. In the UK, I think that if we go into a recession, even a small one next year, impairment charges could quite easily go up again, and therefore banks may need more capital.
And so you're confident that the FTSE will outperform the CAC and the DAX, as we showed they did so last year. Is this because the UK has safe haven status, or is it just because, although times are tough in the UK, they're just less tough than they are in Europe?
I think partly it's they're less tough than Europe, partly it's that we do have the flexibility of exchange rate that can go down. We are also using quantitative easing to offset some of the difficulties that paying back the debt has, the austerity measures that we have to put in place for our credibility with fiscal policy. So the recession won't be as bad in the UK as it is elsewhere, but also the earnings from UK companies, 75% of them are outside of the UK, and a lot of that is from emerging markets and also the US.
So give us your top three picks then for next year.
So my top three picks, unsurprisingly, are going to have very little European exposure. They're going to be quite defensive. They want to have visible earnings. So Compass is the first one. This is a contract catering company, very strong market position, global reach. 50% almost of their sales are in the US. US seems to be recovering better than the other areas. There they currently have 5% organic growth. So a bit of growth coming on the top line. But the main story behind Compass is they're generating huge amounts of cash, and they would have cash on the balance sheet in 2 years' time, which means that they probably are going to be able to increase dividends. They've already announced some share buybacks. All this is earnings enhancing and should give the shareholder a good return.
And Babcock you like as well?
Babcock is a defence company. Outsourcing is a big trend in the UK to save more money. The stock's trading only on 11 times earnings. Again, cash generative, dividend yield of 3%, high visibility earnings, winning lots of contracts.
And Rockhopper, a company
Yeah.
not so many people will have heard of.
This is a more speculative stock. This really is an EMP stock based in the Falkland Islands. It has definitely discovered oil, and what's so exciting about it at the moment is that they are coming to the point where they're going to have to work out how to finance that development, and they're going to do a farm-in with a big oil company, and that will then give the market the credibility that they can get that oil out of the ground. So all being well, that stock could double. The other ones, I think, are safe havens, good returners.
Jane Coffey from Royal London Asset Management, thank you very much indeed for those tips.
Thank you.